Hello, everybody. Thank you for joining us for today's public webinar. Good morning, Jim.
Good morning. Good morning. I woke up a couple times during the night looking to see what was really going on. Okay, let's start. And what I've done is I've started with a monthly bar chart. As you can see, for 5 months, the market has moved sideways. So we look at this from the monthly viewpoint. Now I want to come down and I want to look at it from the weekly. See the same thing. And now I want to look at it from the daily. Okay, so the market is in a 5-month balance or trading range. I've drawn these trend lines, and I'm not a trend line person, so don't test me on the exactness of it. I wanted to show you, which you've heard me say before, if you've followed any of what I do, this is an indication of short-term traders. These are the laggard short-term traders mechanically buying the market. When you see this exactness, that tells me who I'm competing against. These are short-term traders. They get too long and you get the liquidation. They do it again, you get the liquidation. They do it again, again, and again. This is all short-term traders that have it's gone on for, like I say, 5 months. You can see where the low is of this trading range. Now, when we see this, what it also tells me is the longer time frame has not been aggressive. They have sold into what the short-term time frame is doing, but it's been very minor. It's just very minor. They let a little bit go, but no downside follow through. Talking to a couple of clients / friends that are with some of the major trading firms and institutional firms, consistently, the message that I am getting is that the longer time frame is overly long. They're complacently long. I'm getting that they're underinvested in Europe. So that's why we've had, some rallies, a little stronger markets in Europe. And we've got nothing here because the market has been long for so long. That is a very dangerous situation. When the market gets overly long, just as it gets overly long from us as short-term traders, we know we get these constant, liquidation breaks and short covering rallies. That same potential can happen with the longer time frame. Doesn't have to happen, but it can. So where we are as we come in today, we are right at the level, the low of this 5-month trading range. And you've heard me over and over again, this is a form of balance. The longer the balance, the greater the potential exists if the market breaks out of that balance. But balance trading guidelines are still applicable. Stay within balance, look below balance and fail, or break to the downside. So that's what we're looking at this morning. It's a go, what I call a go, no-go level. Now, one of the things that I recently wrote, and I think Jen has posted it to our site, it's really learning how to observe. If you have only one way to look at the market, and that's the way you trade, the odds are that you are going to have a very difficult time in the market. Markets are random. Markets are random, and you have to be able to adjust to the market. The market's not going to adjust to you. Many of you know that my favorite writer is Josh Waitzkin's. My favorite book is Josh Waitzkin, and the Jen, I just drew a blank. What's the name of the what's Waitzkin's book's name?
The Art of Learning?
Oh, The Art of Learning. I listened to a podcast between Waitzkin's and a neuroscientist from Stanford by the name of Huberman. And one of the things that Waitzkin's talks about, I mean, here's a guy, if you don't know Waitzkin's, again, he was an international champion in chess. Then he moved away from chess and he became international champion in the martial arts. Two totally different disciplines. But what he talks about is the mental flexibility. He talks about one example where he won a national championship. And he talks about all the experts in the world spent a year analyzing what he did and what his final words were, you know, to win this. So spending all this time on what he did. And in the meantime, he revamps everything that he's done. So the things that they're studying, he doesn't even look at it anymore. He's totally revamped it because he's not married to any one particular approach. And I get traders all the time that whether it's the VWAP or the 200-day moving average or the 300-day or the 50-day moving average, they're wedded to these favorite markers that they use. And I really think because the market is random, you have to learn to be flexible and to be able to look at the market each day with a fresh look. It's seldom that we've ever seen anything like this, but you look at this, it's what the market's been doing. And I've been writing this up every weekend, and I get some people that are just furious with me because I'm missing this, and I'm missing that, their favorite tool. So anyhow, this is what I see the market. So this morning, as we come in this morning, we've got, we've got a lot of emotion in the market again, because we've got all this talk of tariffs. And we've seen for months, every time, or for weeks, every time tariffs are mentioned, the market falls and then the market rallies. So now we've got the tariffs that went into effect last night. So now we've got the market down on the lows. Okay, let's go take a look at where we are on the, you saw where we are about that 580 level. So we're coming into the market. And we're overnight inventory was long, and then we got a liquidating break, and overnight inventory is probably fairly well balanced now. So this is where you saw where we are in the bar charts. We are at, from a destination standpoint, we are at the low of the trading range. So the question remains, do we break out of that trading range, or do we remain in the trading range? Do we look below and fail, or do we look below and accelerate lower? I don't think it's any more difficult than that this morning. And I don't want to make any more out of it than that. It's staying flexible. It's staying flexible in the market, understanding what you're dealing with. You have an important level. You're at a go, no go level. You've looked right back, right at the low of, 5 months of trading range. Are we going to go through it, or are we going to rally? Jen, let's open up for some questions.
Jim, I'll do the commercial first, real
Okay.
quick. 1 second. Let me take the screen back. Can you see my screen?
I can't.
Okay. So for those of you that are new, if you're not familiar with our website, jimdeltontrading.com, if you're interested in signing up to receive our emails and notifications about webinars and course announcements, you can sign up here in this black strip, and then you can also find our YouTube channel there. And the article that Jim was talking about that we just released is under resources articles right here. Just want you to be able to find it. And it's the first one up here at the top. We do have a primer course, a updated live market profile primer course that's going to be running from April 23rd to May 1st. It's an 8-day live course. All of the sessions are recorded in case you're not able to join all of the sessions live. I know that we have many clients that live in different parts of the world or clients that have day jobs, so they're not able to always attend every session live, but they are recorded, and participants of this course will have access to the materials for 3 months after it finishes so that you have time to review. You do not have to have any prerequisite requirements to join us for this course. And sorry, my throat. And you do not have to have market profile charts in order to join us for this, unless, of course, you want to be able to observe the markets on your own when we're not in class. So you can find more information about this on our website. Go to jimdeltontrading/courses at the top. We also have the schedule posted there so you can see the timings of everything. And if you have any questions, don't feel free to email us at delton@jimdeltontrading.com or call us, and I'd be happy to speak with you. Okay. And also, if you don't know it yet, hopefully most of you do and already have it, but Jim's new book, Markets and Momentum, is out, available on Amazon, and you can find this under resources books. Okay. And you can also see all the other books that we recommend that you read as well. Okay. Jim, I'll give you back the screen.
Thank you.
Okay, let me give you back the screen there. There you go.
Okay, and let's open for some questions.
Okay, are you looking at the VIX?
Not really. I mean, I'm aware of the VIX, but I'm not glued. I'm not glued to the VIX. I'm simply aware of it. And when the VIX rises, as it does, what I will end up doing a lot of times, because I use options, and if I buy, let's say, for example, I have bought some calls in case the market rebounds, to hedge my short positions. Because the volatility is so high and the premium, or at least it's risen, I think it was 23 last time I looked, then I will do more spreads. In other words, so if I buy a long call, I will spread it off by selling a higher price call in order to adjust for the additional risk in the premium. But I do watch the VIX, and it's been amazing to me, as much as this market has fallen. I mean, the VIX, probably the long time average on the VIX is probably someplace around 18 or 19. And the VIX has actually been well behaved for the volatility in the market. Other questions?
Okay. I've been using the TPO chart going on for 4 years. This year I found your YouTube and started reading Mind Over Markets. I know there may not be a direct answer to this, but aside from daily practice, what are your thoughts on honing intuition?
It is a lifelong practice. And this is what we talk about so much when we go through our educational courses. It's not going to happen overnight. It happens one small piece at a time on a continuous basis. It's very similar to how you learn to drive. You start off with the very basics. The more experience you get, the more powerful and the more important it becomes. You will find when you talk about reading Waitskins or anything like this, our brains are so powerful, but it is amazing that we don't really know how to use them in a lot of cases. I mean, that's why it's important, and that's why I read so much about the brain and how the brain changes. So, but I do think that without honing intuition, and which means it comes with experience, I don't think your odds of becoming a successful trader are very good. It's just like, you have all these people that sit in the stands, they know all the statistics on baseball, but they couldn't hit the ball if they tried. It takes thousands of pitchers, thousands of pitches coming at you, and you pick up the nuances and hone that intuition. And as one of our clients who is 23 years as a baseball coach says, it may be as subtle as just noticing that the pitcher's a little bit of different shape of the glove, indicating that the pitcher's holding the ball a little differently, and it may be a different type of pitch. And you get to the point where you don't even know you noticed it. Okay, other questions? Great question. Thank you.
Okay. We have single prints above from yesterday's cash, but some were traded through in the Globex. Do you disregard singles now, or do singles still apply into the cash open?
No, I don't pay. The only thing I really pay attention to in the overnight, I pay attention is the inventory long or short. And, early on, the inventory was long, and now the inventory has become short. But I don't pay, well, if there's a double distribution, I will pay attention to the double distribution because, for example, if you take a look, there's a double distribution here. It happens to be right at half back now. If there's any real strength, they'll close this. The failure to close this double distribution is an indication that the weakness that we're seeing coming into the opening has carried through. If we don't close it, if we close it, that tells us that that weakness was not as obvious as it looks. If we do close it, then the market was probably too short. Okay.
Okay. Do you consider the fact that the market is near the 200 SMA, or is it a nuance?
It's a nuance. I mean, it's like the NASDAQ. The NASDAQ was dancing around it for the last, couple of days. There is a tremendous number of people that look at the 200-day. And of course, the more people that look at it, the more relevance it has. But I don't get glued to a single reference. I'm not oblivious to it. But when I looked this morning, what's my biggest thing this morning is you saw the bar chart. We're at a go, no go level. And that's what I'm looking at this morning. Do we break to, the balanced trading guidelines are in play this morning. It's a huge trading range or balance. Do we break below it and extend lower? Do we look below it and fail? Or do we rotate back up to the opposite end? That's my guideline this morning, rather than a specific reference point. So that's why I started with the bar chart. So I started with the bar chart, and this morning, let me go back, and I say, this is my reference. I don't care if it's the 30-day, 50-day, 200-day. This is my reference right here. Do I hold this trading range, or do I look below it and extend, or do I look below it and fail? That's what I'm looking at this morning. Okay, what else?
Okay. Do you monitor the positioning of dealers in SPX options since they use futures to hedge their positions?
No, I do not. I'm aware of they can get in trouble with their hedges, and sometimes they have to buy or sell in order to keep the hedges adjusted. But I try and stay fairly loose and look at the market and what is going on right in front of me. Now, what I also tend to do is, because of the volatility has gotten high recently, or higher, and the volatility has been great. I'm using a strategy currently that I have said historically is one of the worst strategies you can ever use. But it's been working right now because of the volatility we've had. I am buying strangles or straddles. Now, the important thing is if you get a move that doesn't follow through. So let's say that I buy a straddle and the first move is up, and the move up, the calls fail, then I will fade, or I will sell a higher strike price against those to take in cash. And then I will play on the other side. That has helped me tremendously because of this trading range that the market's been in. But you got to be careful. What I'm trying to say early on, no, don't get glued to any one thing. Like I've said, historically, it was one of the worst possible strategies you can imagine. Now it has been working because of what the market's doing. So I try and just adjust to the market. The other thing that I'm doing more and more is I'm using the SPY much more than I'm using the futures. And I'm using the SPY because the fills, the slippage is really good. There's very little slippage, far more slippage in the ES. The ES is fine. There's very limited slippage in the ES if you're trading 100 lots. I'm not a 100 lot trader. If you're trading, you're trading small lots like 4 to 5, the slippage is very large because it's a market that's better designed for the institutions than for the individual. And I find it's much tighter market in the ES or in the SPY. So I've been using that very, very heavily. Okay, final two questions.
Okay. Let me see here. Okay. What exactly would you consider that it looked below the balance and failed? Would you wait for the end of the day?
No, absolutely not. No, that's far too late. You've got to make adjustments. You got to look and see how much confidence is there. If the market opens and there's good confidence, go with it. I would never wait till the end of the day. I'm a daytime frame trader. So I'm going to observe what the market's doing right in front of me. Okay, final question.
You mentioned a lot about short-term traders in the market. Don't you think that's because of the options market has quadrupled the last 5 years or so, and traders use options to hedge against? There will be a lot of short-term behavior in the markets going forward.
Markets change all the time. I've been around the markets for 50 some years. And, right now, yeah, there's a lot of short-term traders. If you look at the 5-month trading range, all we've had are short-term traders in this market. That's all we've had. The longer term, as I said early on, the longer term has been long for some period of time. And remember, they make their money with time in the market. But they've been nervous. They're overly long, which is a dangerous situation. But I don't, I don't worry about the data. I use the zero dated options. I use them for my volatility in there. It works just fine for me, but I don't get married to them. All right, I'm going to say thank you because I do have some positions I have to work on this morning. I want to say thank you very much, and I hope you consider joining us for the next primer if you're interested in a little deeper understanding of what we do and how we look at the market. Thank you very much. Have a great trading day.
Thank you so much, everybody. See you at the next one. Take care. Happy trading.